Have you ever stared at your tax forms, maybe eyes glazing over a bit, only to spot those stubborn, suspended losses from an investment or maybe a business activity that just won't budge?
Yeah, it feels like money's stuck in limbo. Right.
Exactly. Trapped sometimes year after year, just waiting for that, I don't know, magical moment to finally make a difference on your bottom line.
Uh-huh.
Well, today we're doing a deep dive into precisely when and how those suspended losses and, even those equally frustrating unallowed credits can finally work for you, especially when you dispose of a passive activity.
That's right. Our mission today is really to cut through the often dense jargon around these rules. We want to empower you with a clear understanding of how to calculate the utilization of those suspended losses when you dispose of a passive activity for tax purposes.
Right.
And we're really focusing on the incredible tax benefits this can unlock. I mean, turning what felt like lost deductions into real, tangible savings. It's often like the single most overlooked moment in a taxpayer's journey with these passive activities.
Absolutely. Think of this deep dive as your personal guide. Navigating IRS forms like 8582, 88582 CR, uncovering the specific rules that, transform those carried forward numbers into cold, hard tax relief.
Yeah.
So whether you're a seasoned investor, maybe someone like Alex who just sold off a rental property and is wondering, okay, what happens to years of accumulating losses?
Right.
Or maybe a budding entrepreneur, or perhaps just someone who's insanely curious about optimizing their financial picture, understanding these rules can be a powerful aha moment.
Yeah, definitely.
You'll learn the crucial differences between activity types, the precise conditions under which losses are fully released, and even how certain unallowed credits can strategically increase your property's basis. That directly impacts your gain or loss on sale. Okay, let's unpack this.
So to begin, we really need a crystal clear understanding of what the IRS actually means by a passive activity.
Okay.
At its core, a passive activity is generally defined as a trade or business activity in which you, the taxpayer, do not materially participate. That's key.
Materially participate.
Got it. And it also includes virtually any rental activity, regardless of your personal involvement, unless you meet some very specific exceptions we'll get into.
Okay.
These rules apply broadly. They affect individuals, estates, trusts, well, excluding what are known as grantor trusts, and also personal service corporations and closely held corporations. It's, a broad net designed to catch many different scenarios.
And the why behind these rules is so important, isn't it? Why does the IRS even care if I'm passive or active in my endeavors? Sometimes it feels like a distinction just designed to make things more complicated.
It's a fair question. And beyond simply preventing what some might call, creative accounting or maybe tax shelters,
Right.
these passive activity loss or PL limitations were put in place to distinguish between what the IRS sees as genuine business risk and, well, investment vehicles primarily used to generate sort of artificial losses for tax purposes.
Okay.
The intent was really to ensure that losses from passive investments couldn't be used to just indiscriminately offset your active income, like your wages or profits from a business you're fully engaged in, or your portfolio income, like interest or dividends from stocks.
So it stops someone with a high salary from just buying rentals to zero out their taxes?
Exactly. Without these rules, someone with a high salary could, theoretically, buy a series of rental properties, incur maybe paper losses through depreciation, and use those losses to wipe out their active income, reducing their tax bill significantly without necessarily, taking on a true business venture.
Makes sense.
So these losses get suspended, meaning they're put on hold, carried forward to future years, just waiting for a specific, often strategic event to be utilized.
That distinction makes a lot more sense now. It's about ensuring fairness, preventing what they see as tax avoidance. So the crucial question becomes, when isn't an activity passive? Because that's where the real planning and opportunity comes in.
Right.
The gateway to active status, as we've hinted, is often material participation.
Indeed. A trade or business activity is not passive if you materially participated for that specific tax year. And this is where the intricacies really begin. The IRS provides 7 distinct tests to determine if you've met that material participation threshold. It's not always as simple as just, showing up or putting in a few hours.
7 tests. Okay, let's dive into some of the most common ones, the ones our listeners are most likely to encounter, and maybe even some that commonly trip people up.
Absolutely. The first, and often the clearest path, is participating for more than 500 hours in the activity during the tax year.
500 hours.
If you hit that mark, you're generally considered to have materially participated, and the activity is active for you. That's kind of the benchmark most people aim for.
That's pretty straightforward. I mean, if you're genuinely putting in that kind of time, it's hard to argue it's not active. What's the next key test?
The second test looks at situations where your participation in the activity for the tax year was substantially all the participation of all individuals involved. That includes people who didn't even own an interest.
Substantially all. So, if Alex is running a small online store entirely by himself,
Exactly, even if he only spent, say, 300 hours on it. If he was truly the only one doing the work, that counts as material participation under this test.
okay, so if I'm pretty much a one-person show, even if it's less than 500 hours, it could still be active? That's helpful.
That's exactly right. Then the third test is if you participated for more than 100 hours during the tax year, and you participated at least as much as any other individual involved in the activity.
More than 100 hours, and nobody else did more.
Right. So if there are others involved, but no one put in more hours than you did, and you cross that 100-hour threshold, you're considered active. For example, if Alex ran his online store for 150 hours, and maybe his assistant only worked 50 hours.
He meets the test.
He meets the test, yeah.
What about those activities where you put in some time, but maybe not a ton, across a few different ventures? I know a lot of entrepreneurs, they juggle multiple side hustles.
That brings us to the fourth test, which involves what are called significant participation activities. This one's a bit tricky.
Okay.
A significant participation activity, or SPA, is a trade or business activity where you participated for more than 100 hours during the year, but you didn't materially participate under any of the other tests we just talked about.
So over 100 hours, but not enough for the other tests.
Correct. Now here's where it gets interesting. If you participate in all such significant participation activities for more than 500 hours combined during the year.
The 500-hour rule again, but combined.
Right, combined across all your SPAs. If you hit that, then all those activities are considered non-passive.
So if Alex had 3 separate side businesses, putting 200 hours into each, totaling 600 hours, they'd all be considered active. That sounds great. But there's always a catch with the IRS, isn't there?
Precisely. There's a really crucial nuance with significant participation activities.
Right.
If any single SPA generates net income, that income gets recharacterized as non-passive.
Recharacterized as non-passive,
Yeah.
meaning
You can't use passive losses from other unrelated passive activities to offset that specific income.
okay.
However, any losses from such an SPA remain passive unless they can be offset by income from other significant participation activities you group together.
Wait, so the income becomes non-passive, but the losses stay passive. That seems weighted.
It is. It means you can't use a loss from one SPA to offset your active wage income, for example. But the income from another SPA might not be passive income for pool purposes, which limits your ability to use other passive losses against it. It's basically designed to limit loss deductions while keeping income active.
So it's a bit of a trap. Income can get pulled out of the passive bucket, but the losses tend to stay in unless there's offsetting income from other SPAs.
Wow, it really seems the IRS wants to limit those loss deductions wherever possible.
Indeed. They are very focused on that. Okay, moving on. The 5th test is quite broad. You materially participated in the activity for any 5 of the 10 immediately preceding tax years.
5 out of the last 10. That recognizes a history of involvement. Exactly. It provides continuity. So if Alex was running a business actively for years, then maybe he takes a sabbatical for a year, he might still be considered materially participating because of his past involvement.
That's a great safeguard for established business owners who might take a step back for a year or two. They don't suddenly become passive just because of a temporary dip in hours.
Exactly right. The 6th test is similar, but it's specific to personal service activities.
Okay, like doctors, lawyers.
Yes. This applies if you materially participated in a personal service activity for any 3 preceding tax years. And personal service activities include fields like health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting. Basically any trade or business where capital isn't a material income-producing factor.
Got it.
So if Alex was a consultant who consistently worked full-time for several years, even if he scales back his hours significantly one year, he could still be considered materially participating based on that history.
So a professional who's been active, even if they ease up towards, say, semi-retirement, could still meet this. That's a huge relief for many.
That's the idea. Finally, the 7th test is the facts and circumstances test. This is a bit of a catch-all.
The fuzzy one.
Kinda. Based on all the facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis during the tax year. However, there are crucial limitations here.
Okay, what are they?
You don't materially participate under this test if you participated for 100 hours or less. That's a floor.
In the 100 hours or less, you're out for this test.
Right. Also, your participation in management doesn't count if anyone else received compensation for managing the activity, or if any other individual spent more hours managing the activity than you did, regardless of whether they were compensated.
So you can't just make a few high-level decisions if someone else is doing the real management work.
Exactly. This prevents someone from claiming material participation just by, making a few decisions from afar if others are really running the show day to day. The IRS is looking for genuine, hands-on engagement.
That makes perfect sense. They want real, demonstrable involvement. Now, what about the nuances of work itself? Does all work count towards these hours? Like, if Alex is just reviewing financial statements for an investment, does that count?
Good question. Not all work counts. For instance, work you typically wouldn't do as an owner, or work done primarily just to avoid loss disallowance under these passive activity rules, that doesn't count.
Gaming the system.
Right. The IRS is looking for bona fide participation. Also, work done purely as an investor generally doesn't count towards material participation unless you're directly involved in the day-to-day management or operations of the activity.
So just reading reports isn't enough.
Generally, no. Merely studying financial statements, monitoring operations from afar, or preparing summaries for your own use without direct involvement in the day-to-day business decisions. That usually isn't enough to make it active. You need to be actively making decisions that impact the business.
Good to know. What about spouses? If my spouse is involved in an activity I own, does their participation help me meet these tests?
Yes, happily. Participation by your spouse during the tax year in an activity you own counts as your own participation.
Oh, that's great.
Even if your spouse didn't own an interest in the activity, or even if you don't file a joint return, it's treated as a combined effort for tax purposes, allowing you to pool your efforts to meet those material participation thresholds.
That's a very helpful rule. And limited partners, they often have restricted involvement, so I imagine it's harder for them to materially participate.
You're right. Generally, limited partners don't materially participate. Their role is typically to invest capital, not to manage day-to-day.
But there are exceptions.
Yes, there are. A limited partner can materially participate if they meet Test 1, more than 500 hours, Test 5, material participation in 5 of the 10 prior years, or Test 6, personal service activity for 3 prior years.
Okay, so the hours test or the look-back test?
Exactly. So if Alex were a limited partner in, say, a tech startup, he'd need to be very heavily involved, putting in over 500 hours, or have a significant history of involvement to be considered active.
Makes sense.
Also an important detail. If you're also a general partner in the same partnership for the entire tax year, you might not be treated as a limited partner for these tests, which could potentially make it easier to meet material participation.
Interesting distinction. Any special considerations for farmers? Their business is pretty unique.
Yes, there are specific provisions. Certain retired or disabled farmers, or the surviving spouses of farmers, can be treated as materially participating in a farming activity under specific conditions.
Yeah.
This applies if the real property used in the activity meets the estate tax rules for special valuation of farm property passed from a qualifying decedent. So there are provisions for continuity in farming businesses, recognizing that generational aspect.
That's a really comprehensive overview of how to classify trade or business activities. But what about rental activities? You mentioned earlier they're almost always passive, even if you materially participate. That seems like a big hurdle for real estate investors like Alex.
It is a significant distinction and a common point of confusion. Rental activities are generally considered passive regardless of your material participation. Unless.
The big exception.
Yes, the crucial exception. If you qualify as a real estate professional, this is really the golden ticket for many rental property owners who want to deduct losses against other income.
The real estate professional. That's the key designation everyone talks about. Tell us more about the requirements. I hear they're pretty stringent.
They definitely can be. To qualify as a real estate professional, you have to meet 2 strict conditions for the tax year. First, more than half of your personal services performed in all trades or businesses during the year must be performed in real property trades or businesses in which you materially participated.
More than half your total working time. In real estate businesses you materially participate in.
Right. And second, you must have performed more than 750 hours of services during the year in real property trades or businesses in which you materially participated.
750 hours plus the more than half test. Both.
Both conditions must be met. It's a high bar, ensuring that real estate is truly your primary professional focus, not just a side investment.
So it's not enough to just own a few rental properties on the side. You have to be deeply involved in the real estate business as your main gig, essentially.
Exactly. It really implies a full-time commitment. And a real property trade or business is defined broadly. Includes development, redevelopment, construction, acquisition, conversion, rental, operation, management, leasing, or brokerage of real property. Okay, quite broad.
But services you perform as an employee generally don't count towards these hours or the more than half test unless you own more than a 5% interest in the employer.
So my W-2 job as a real estate agent doesn't automatically qualify me if I just own one small rental property on the side.
Correct. That prevents, say, a real estate agent working for a large firm from counting all their employee hours towards this test if they only own a small passive rental interest themselves. You need significant ownership or be self-employed in that real estate business.
And if you have multiple rental properties, say Alex owns 3 different apartment buildings, does he have to meet the 750-hour test for each one separately? Or can he combine them somehow?
Great question. By default, each interest in rental real estate is considered a separate activity for determining if you materially participated as a real estate professional.
Each one separate. That sounds incredibly hard.
It can make it very difficult, almost impossible sometimes, to meet the hour requirements for each individual property. However, you can make an election.
An election. You can elect to treat all your interests in rental real estate as one single activity. This election is made on Schedule E and can be absolutely critical for meeting the 750-hour and the more than half thresholds.
So you combine the hours across all your rentals.
Exactly. It allows you to aggregate your time spent on all properties. Without this election, it would be almost impossible for most individuals with more than one rental property to qualify as a real estate professional.
That election sounds crucial, or anyone with a rental portfolio trying to qualify. Now, what if an activity looks like a rental activity, but isn't really one under the tax law? Are there exceptions to that classification that could open up more deduction opportunities, maybe avoid the whole real estate professional test?
Yes, there are 5 specific exceptions. If an activity meets any one of these, it's not treated as a rental activity for the passive activity rules.
Not a rental activity, meaning?
Meaning it gets classified as a trade or business activity instead. And then its passive or active status hinges on whether you materially participate under those 7 tests we discussed earlier.
So it brings those tests back into play. If you materially participate, it becomes active.
Precisely. It could be a game changer.
Let's hear them. These could be really important for certain property owners. What's the first one?
The first exception is if the average period of customer use is 7 days or less.
7 days or less, like short-term rentals.
Exactly. Think of a short-term Airbnb rental, a hotel room, maybe renting out equipment by the day. If the average customer stay is a week or less, it's generally not considered a rental activity under these rules.
So a truly short-term rental isn't automatically passive. That's a huge distinction, especially now with platforms like Airbnb being so common.
It is very significant. The second exception is if the average period of customer use is 30 days or less, and these significant personal services are provided in connection with making the rental property available.
Okay, 30 days or less plus significant personal services. What counts as significant?
That's the key. It's more than just basic property management. Simply providing basic cleaning between short-term guests likely doesn't count. But if you're running, say, a full-service bed and breakfast with daily bespoke meals, concierge services, maybe daily room cleaning, constant guest interaction, that level of active involvement could qualify.
So it's about the level of service beyond just providing the space.
Right. The IRS looks at factors like the frequency of the services, the type and amount of labor required, and the value of the services relative to the rent charged. Services that are just required to permit lawful use of the property, like cleaning common areas in an apartment building, generally don't count towards this.
Okay, so it's not just about the short stay, but also about the active, tailored service being provided. That clarifies it. What's the third exception?
The third is when the rental of the property is incidental to a non-rental activity. This breaks down into 2 main scenarios.
Incidental.
Okay. 1, it's incidental to an activity of holding property for investment. This applies if the main purpose of holding the property is really for appreciation, and the gross rental income is less than 2% of the smaller of the property's unadjusted basis, or its fair market value.
2%. That's tiny.
It is. So, for example, if Alex owns a vacant lot, primarily hoping it goes up in value, and he lets a farmer graze cattle on it for a small fee, If that grazing fee is less than 2% of the lot's value or basis, the rental is just incidental to his investment activity.
Got it. And the second scenario for incidental.
2, it's incidental to a trade or business activity. This applies if you own an interest in the trade or business. The property was mainly used in that business during the current year or at least 2 of the 5 preceding tax years. And again, the gross rental income is less than that 2% threshold of the smaller of basis or fair market value.
So if a business occasionally rents out some space, it primarily uses itself, and the rent is minimal.
Right. Imagine a graphic designer who owns her office building and mainly uses it for her design business, but occasionally rents out a spare office for meetings or events. If that rental income is very small, under that 2% test, it's incidental. But if it creeps just slightly over that 2%, that seemingly minor rental could unexpectedly become a separate, passive activity, potentially creating issues.
Wow, that 2% rule is incredibly specific and sounds like a real trap for the unwary. You could accidentally create a passive activity without realizing it. What about the fourth and fifth exceptions?
The fourth exception is if you customarily make the rental property available during defined business hours for non-exclusive use by various customers.
Non-exclusive use, like a golf course.
Exactly. Think of a golf course, maybe a parking garage, or even renting out a meeting room where multiple different groups might use it throughout the day during business hours. It's about shared access during business hours, not giving someone exclusive possession for a period.
Like a gym or maybe a shared workspace, perhaps. Got it.
Yes, potentially. And the fifth exception is if you provide property for use in a non-rental activity of a pass-through entity, like a partnership, S-corporation, or joint venture in your capacity as an owner of an interest in that entity.
Providing property to your own partnership or S-corp.
Right. A pass-through entity is one where the income, losses, deductions, and credits aren't taxed at the entity level itself. They pass through directly to the owner's personal tax returns.
Avoiding double taxation.
Correct. So if Alex contributes a building he owns to a partnership where he's also a partner, and the partnership uses that building for its active consulting business, Alex's act of providing the building to the partnership isn't treated as a passive rental activity for him. It's part of his involvement in the partnership's business.
These exceptions are really important because, as you said, if your rental activity falls into one of them, it suddenly becomes a trade or business activity. And then your ability to deduct losses hinges on those material participation tests we spent time on earlier.
Precisely. It shifts the entire analysis.
If it's then classified as a trade or business activity where you didn't materially participate, the losses would still be limited, right?
Yes, they'd be passive.
Yeah.
But if you did materially participate under one of the 7 tests, then you report the income or loss on the forms you normally use, like Schedule C or E, and potentially deduct those losses directly against your other income. It opens the door.
Okay. Before we move on to dispositions, there's also something called active participation for rental real estate. That sounds like a step down from material participation. What's that about, and how does it provide relief? Is it different from the real estate professional status?
It is different, and yes, active participation is indeed a less stringent standard than material participation. It's specifically for rental real estate activities. It doesn't reclassify the activity as non-passive entirely, like the real estate professional status can.
So what does it do?
It allows a special allowance of up to $25,000 for certain deductions and credits related to the rental activity. This is often referred to as the $25,000 special allowance.
$25,000 allowance for what exactly? Losses?
Credits. Both, potentially. The Form 8582 instructions mention losses, and Form 8582CR handles credits. This allowance can let you deduct up to $25,000 of passive losses from the rental activity against your non-passive income, or use an equivalent amount of credits.
That sounds useful. Is there a catch? An income limit?
Yes, there is. This $25,000 allowance is reduced by passive losses from other activities, and it begins to phase out if your modified adjusted gross income, MAGI, is between $100,000 and $150,000 for most filers.
Phased out completely above $150,000 MAGI.
Correct. For married filing separately, the phase-out range is $50,000 to $75,000. So if Alex, as a single filer, makes $125,000 in NGI, his $25,000 allowance would be cut in half to $12,500 because he's halfway through that phase-out range.
Okay, so it helps people below those income levels. How do I qualify for this active participation? What's the minimum involvement needed? Is it easier than material participation?
It is generally easier. You're considered to actively participate if you make management decisions in a significant and bona fide sense.
Significant and bona fide management decisions like what?
This includes things like approving new tenants, deciding on rental terms, approving capital expenditures or repairs, things like that. It's more about being involved in the key management decisions, not necessarily the day-to-day grunt work like mowing lawns or collecting rent checks yourself.
So more strategic oversight. Is there an ownership requirement?
Yes, there is a key requirement. Your interest in the activity, and this includes your spouse's interest, must be at least 10% of all interest in the activity throughout the entire tax year.
10% ownership minimum.
Right. And estates can also qualify for active participation for up to 2 years after the decedent's death, provided the decedent would have qualified in the year they died. It offers a brief window there.
That's a useful distinction and definitely offers a lifeline for many smaller landlords who aren't full-time real estate pros but are still involved. Okay, now that we've laid all this groundwork for classifying activities, let's get to the main event.
The part everyone's waiting for. Disposing of a passive activity.
The moment of truth. Here's where it gets really interesting, because this is when those suspended losses can finally be unleashed, right? This is the big payoff, potentially.
This is truly the primary trigger event. If you dispose of your entire interest in a passive activity, or even a former passive activity, one that used to be passive, in a fully taxable transaction to an unrelated person.
Okay, a lot of qualifiers there.
Yes. If you meet all those conditions, then any unallowed passive activity losses from that specific activity, including any current year losses from it, are generally allowed in full in the year of disposition.
Allowed in full. Wow.
This is the main, most powerful mechanism to finally unlock those suspended losses that might have been sitting on your tax forms maybe for years.
So entire interest, fully taxable transaction, and unrelated person are the absolutely crucial elements. Let's break those down, because getting any of them wrong means those losses probably stay locked up, right?
Correct. Missing any one of these usually prevents the full release.
Okay, first, entire interest. What does that mean exactly? Does it mean selling every single passive activity I own?
No, not necessarily all of them. It means you must dispose of everything you own in that specific activity, as defined for tax purposes.
Ah, so it depends on how the activity is defined or grouped.
Exactly. You can't just sell off a piece of an activity and expect the full release of all its suspended losses. For example, if Alex owns 3 distinct rental properties, and he correctly treats each one as a separate activity on his tax returns,
Okay.
selling just one of those properties allows the suspended losses specifically allocated to that property to be released. But it doesn't release the losses tied to the other 2 rentals he still owns.
But if he had grouped them...
Right. If he had made that election we talked about earlier to treat all 3 rentals as a single activity, that he would need to sell all 3 properties to trigger the release of the combined suspended losses for that entire grouped activity.
So how you define or group your activities up front has huge implications down the road at disposition.
Absolutely critical. Okay, second qualifier, fully taxable transaction. Does that mean no fancy tax maneuvers like exchanges? It's generally right. A fully taxable transaction means the disposition must be one in which all realized gain or loss is recognized for tax purposes in that year.
Recognized gain or loss?
Yes. This typically means a straightforward sale for cash or maybe notes. It usually excludes things like a like-kind exchange, a Section 1031 exchange, or a gift, or maybe an involuntary conversion where the gain or loss might be deferred or not recognized immediately. The IRS wants to see a clear, complete economic event where the gain or loss is calculated and hits a tax return right then.
Got it. Cash sale is the clearest example. And third, unrelated person. This seems like a common pitfall. Who qualifies as unrelated? Can I sell to my brother, my business partner, my closely held corporation?
Unrelated person is a critical definition here, and it's definitely where taxpayers can stumble. If you sell your entire interest in a fully taxable transaction, but you sell it to a related party, the losses generally remain suspended.
They stay locked up even then?
Yes. They are not released until that related party subsequently disposes of the interest in another fully taxable transaction to an unrelated party.
Okay, so who counts as related? My brother.
Yes, family members are generally related persons. Specifically, this includes brothers, sisters, whole or half-blood, your spouse, ancestors, like parents or grandparents, and lineal descendants, like children or grandchildren. In-laws are generally not considered related under these specific rules, interestingly.
Huh. Okay, so immediate family mostly. What about entities?
It also extends to certain controlled corporations or partnerships where you hold a significant interest. generally more than 50% ownership, though constructive ownership rules can apply.
So I can't just sell it to my own company.
Usually not, if you control it.
Oh,
The IRS defines related persons quite broadly here to prevent taxpayers from simply shifting losses within their family or closely controlled entities without a true change in economic position. It's about preventing the perpetuation of the tax benefit without a real disposition.
that's a huge caveat. Selling to family might seem easy personally, but it can completely negate the immediate tax benefit of releasing those suspended losses.
Okay, so what about specific disposition scenarios? Like, what if Alex sells his passive activity using an installment sale? Does he have to wait years for all his losses?
Good question. With an installment sale, the rules adjust to match the timing of the gain recognition. If you dispose of an entire interest using the installment method, your suspended losses are allowed pro rata each year as you recognize gain from the sale.
Pro rata, meaning proportionally.
Yes. So, if Alex sells his rental property on an installment plan and recognizes, say, 20% of the total gain in a given year based on the payments received.
Then he gets 20% of the suspended losses that year.
Exactly. 20% of his total suspended losses related to that activity will be allowed in that same year. It's a gradual release, tied directly to the gain recognition schedule.
That could be useful for spreading out the tax benefit, maybe if you expect high income later, but you don't get the full deduction up
You're
front.
correct. It defers the full benefit. What if Alex just gives his interest away, like a gift, maybe to his child? Do the losses get released then?
Disposing of an interest by gift is a crucial distinction and often misunderstood. If you give away your interest in a passive activity, the unallowed suspended losses are not deductible by you, the donor.
Not deductible at all. What happens to them? Do they just vanish?
No, they don't vanish, but they transform. Instead of being a deduction for you, the basis of the transferred interest in the hands of the recipient, the person receiving the gift, is increased by the amount of those unused suspended losses immediately before the gift.
So the recipient gets a higher basis in the property.
Correct. So while it's not an immediate tax deduction for you, it can potentially reduce a future taxable gain or increase a future deductible loss for the recipient when they eventually sell the property. But for your purposes, as the giver, those suspended losses are gone as a direct deduction. They essentially get absorbed into the property's basis for the next owner.
So it's a basis adjustment for the recipient, not a deduction for the giver. That's a significant difference. And what happens when an owner passes away? How do suspended losses handle a disposition by death? Does the estate get to deduct them?
When a passive activity interest is transferred because the owner died, the unused passive activity losses are allowed as a deduction, but only on the decedent's final income tax return for the year of death.
Okay, they can be deducted on the final return. Is there a catch, a limitation?
Yes, there is a very important limitation. The deduction is allowed only to the extent that the unallowed suspended losses exceed the amount by which the basis of the property is stepped up for the heir or beneficiary under the estate tax rules.
The step up in basis, that's where the property's basis is adjusted to its fair market value at the date of death, right?
Generally, yes.
Yeah.
So the deductible loss on the final return is basically the suspended loss minus the amount of the basis step up.
Could you give a concrete example of that limitation? Say, Alex passed away owning his rental property.
Certainly. Let's say Alex passed away owning that rental property, and he had $8,000 in unused passive activity losses specifically tied to it. His heir, let's say his daughter, receives the property, and under the estate tax rules, the property's basis is stepped up by $6,000, meaning its value at death was $6,000 higher than Alex's basis before death.
Okay, $8,000 off, $6,000 basis step up.
Right. In this scenario, on Alex's final tax return, only $2,000 of the suspended losses would be deductible. $8,000 suspended losses minus the $6,000 basis step up. The remaining $6,000 of losses are effectively eliminated. They don't carry over, they don't transfer, they're gone.
Why is that? Why lose $6,000 of the loss?
It's designed to prevent a double tax benefit. The heir gets the benefit of the $6,000 higher basis, meaning less gain when they eventually sell. So the tax code doesn't also allow the decedent a full $8,000 loss deduction for the same economic amount. You only get to deduct the loss that exceeds the basis step-up benefit.
That's a powerful detail and easy to miss. So the prior year unallowed losses are the critical component here, the number we're trying to unlock.
Precisely. Those are the accumulated losses from previous years that were disallowed under the passive activity rules and carried forward on forms like 8582. They're what we're trying to finally utilize, and they combine with any current year net loss from the activity at the time of disposition to determine the total potentially allowable loss.
And when you dispose of an entire interest, how does the overall gain versus overall loss of that disposition affect how you report it, specifically on Form 8582? Because you mentioned it changes the mechanics.
It absolutely changes the reporting mechanics.
No?
If the disposition of an entire interest in a passive activity results in an overall loss from that activity.
Meaning the suspended losses plus current loss exceed any current income or gain from the activity itself.
Exactly. If it's an overall loss situation for that activity in the year of disposition, then typically none of its gains or losses are actually entered on Form 8582 itself.
Not on 8582 at all. Where did they go?
They are reported directly on the normal forms you would use for that type of transaction, like Schedule D for capital gains losses or Form 4797 for sales of business property. And critically, you typically write EDPA next to the entry.
EDPA, what's that stand for?
Entire disposition passive activity. It signals to the IRS that these losses and any gains are fully allowed and are bypassing the usual passive loss limitations on Form 8582 because it's a qualifying complete disposition resulting in an overall loss.
So if Alex sells his rental property at an overall loss, considering suspended losses, he just reports it directly on Form 4797 or Schedule D with EDPA next to it and gets the full deduction immediately, subject to other rules.
Yeah, no, generally, yes. That's the pathway for an overall loss on a complete disposition.
Okay, but what if it results in an overall gain? Say the gain on the sale itself is larger than the suspended losses.
If the disposition of an entire interest results in an overall gain for that activity in the year of disposition, then the gains and losses from that activity are included on Form 8582.
Why the difference? Why put it on 8582 if it's an overall gain?
The reason is to allow those gains, which are considered passive income in this context, to potentially offset any other passive activity losses you might have from different passive activities that you didn't dispose of.
Ah, so the gain from the sale can free up other locked-up losses.
Exactly. The gain from the disposed activity flows through Form 8582 and can absorb suspended passive losses from other passive activities you still own. Even in this case, where it goes on 8582, you'll still usually indicate EDPA on the relevant schedules like 4797 or Schedule D, where the gain or loss is ultimately reported, but it will have passed through Form 8582 first to achieve that potential netting effect against other passive losses.
This sounds like a finely tuned machine, almost like a series of gates the losses have to pass through. And if you get the order of operations wrong, you could miss out on significant benefits or even miscalculate your tax.
That's a critical point. You absolutely have to follow the right order.
Let's talk about that. The interplay with other loss limitations. Because passive activity rules, as complex as they are, aren't the only game in town, right? There are other hurdles losses have to clear first.
That's right. Tax laws apply several different loss limitations in a very specific sequence, and skipping a step or getting them out of order can lead to incorrect tax filings and definitely missed opportunities. It's like a gauntlet for your losses, and each one must be cleared in order.
So what's the very first limitation to consider, even before we think about passive activity losses?
The first hurdle, fundamentally, are the basis limitations. This is most relevant for entities like partnerships and S corporations. You simply cannot deduct losses greater than your adjusted basis in your ownership interest of that activity.
Your basis, that's basically your investment in it.
Essentially, yes. Your basis generally includes your cash contributions, the adjusted basis of property you contributed, plus your share of certain entity debts for which you might be personally liable, depending on the entity type. It gets reduced by distributions you receive and any losses allowed in prior years. If your share of the entity's losses exceeds your basis, those excess losses are suspended right there at the basis level. They carry forward until you have sufficient basis in a future year, maybe from additional contributions or profits.
So you can't deduct more loss than you have basis. Rule number 1. Okay, what's next in the pecking order after basis?
After your losses clear the basis hurdle, you apply the at-risk limitations. This is generally figured on Form 6198. Your deductible loss from an activity is further limited to the amount you personally have at risk in that activity.
At risk. How is that different from basis?
It's often similar, but it focuses more narrowly on your economic exposure, the amount you personally stand to actually lose financially if the activity completely fails. Your at-risk amount includes the cash and adjusted basis of property you contributed, plus amounts you borrowed for the activity for which you are personally liable for repayment, or amounts borrowed that are secured by property you own outside of the activity.
So it's about having real skin in the game, actual money you could lose. What if I borrowed money for the activity, but I'm not personally liable? Like non-recourse debt, where the lender can only take the property itself if I default. For instance, Alex bought his rental property with mostly non-recourse debt.
That's a key distinction. Generally, non-recourse financing where you're not personally liable and the lender's only recourse is to the property used in the activity is not considered at risk. You haven't personally risked losing those funds.
So non-recourse debt usually doesn't count towards my at-risk amount.
Usually not. However, there's a very significant exception, especially relevant for real estate: qualified non-recourse financing.
Qualified non-recourse financing. What makes it qualified?
This is financing secured by real property used in the activity of holding real property. To be qualified, typically, no one can be personally liable for repayment. It must be secured only by the real property. It can't be convertible into an ownership interest. And crucially, it generally must be borrowed from a qualified person.
And who is a qualified person, not my rich uncle?
Generally not. A qualified person is typically an unrelated commercial lender, like a bank, a savings and loan, a credit union, an insurance company, or sometimes a government entity or related person if the loan terms are commercially reasonable and substantially similar to loans involving unrelated persons. It prevents using non-arm's length, non-recourse debt to inflate your at-risk amount.
Okay, so qualified non-recourse financing for real estate can count as at risk. Are there any other types of borrowed amounts that are specifically excluded from being at risk, even if I am personally liable?
Yes, there are important exclusions designed to prevent artificial at-risk amounts. You're generally not considered at risk for amounts borrowed from someone who has an interest in the activity other than just as a creditor, or from someone related to a person other than you who has such an interest.
So I can't borrow from my business partner to increase my at-risk amount?
Generally, no. It prevents schemes where related parties or co-owners provide funding without real, independent economic risk shifting. However, there are exceptions again, like amounts borrowed by a corporation from its shareholders are generally included. And the qualified non-recourse financing exception for real estate can sometimes apply even if borrowed from a related person if the terms are truly commercial.
So first, basis limitations, then at-risk limitations, and then finally come the passive activity loss PAL limitations on Form 8582, right? It's like a layered cake of tax rules, or maybe more like hurdles.
Exactly. Only after your losses have cleared both the basis and the at-risk hurdles do you apply the passive activity rules we spent most of our time discussing. Any losses that are allowed under basis and at-risk limitations then flow to Form 8582 to be tested for passive versus active status. The system is designed to apply the limitations, ensuring genuine economic investment and risk before even getting to the passive activity characterization.
And is there one more layer? You mentioned a gauntlet. Is there something after PL?
For non-corporate taxpayers, yes, there potentially is one more layer. It's the excess business loss limitation, calculated on Form 461.
Excess business loss. When does that apply?
This applies after all the other limitations we've discussed. Basis, at-risk, and passive loss limits have been applied. If you're a non-corporate taxpayer, like an individual trust or estate, and you still have allowable business losses remaining after clearing all those hurdles, they might be subject to this further limitation.
Is there a dollar threshold?
Yes, there's an annual threshold indexed for inflation. For 2023, for example, the threshold for excess business losses was $289,000 for single filers and $578,000 for joint filers. Any allowable business losses exceeding that threshold are disallowed for the current year.
Disallowed completely. Or carried forward.
They aren't lost forever. The disallowed amount under the excess business loss limitation is treated as a net operating loss, or NOL, and is carried forward to future years according to NOL rules. So even if your loss makes it past basis, at risk, and the passive activity rules, there's still this potential final check before you can fully deduct a very large business loss in the current year.
Wow, okay. Basis, at risk, POL, excess business loss. That's the order. And what if the final disposition results in a capital loss? Does that interact with any other limitations after the PL rules release it?
Yes, absolutely. If your disposition of a passive activity interest results in a capital loss, say from selling stock in a passive S-corp or the property itself being a capital asset, that capital loss, even if fully released by the PL rules upon disposition, faces another potential hurdle: the general capital loss limitations under Section 1211.
The $3,000 limit.
Exactly. For individuals, you can generally only deduct up to $3,000 of net capital losses minus capital gains, against your ordinary income in any given year. Any capital losses exceeding that $3,000 limit are carried forward to future years to offset future capital gains or be deducted at the $3,000 per year rate.
So even if I dispose of a passive activity and the PL rules release, say, a $50,000 capital loss, I can likely only deduct $3,000 of it against my ordinary income this year.
That's generally correct, assuming you don't have offsetting capital gains. The rest of that $50,000 capital loss would be carried forward. So unlocking a passive loss doesn't automatically mean immediate full deduction against all income if other specific limitations, like the capital loss limit, apply. It's crucial to track the character of the release loss.
So many interacting rules. It's a complex dance indeed. Let's shift gears slightly to some of the specific benefits beyond just releasing losses, particularly around credits and basis adjustments. Because disposition can unlock value there too, right? It's not just about the losses.
Yes, definitely. Just like passive activity losses, passive activity credits, PACEs, are also subject to limitations. Credits from passive activities generally can only offset tax attributable to net passive income. Form 8582CR is the primary form used to figure your allowed and unallowed passive activity credits.
So credits get suspended too.
They do. But there's a very powerful election you can make specifically when you dispose of an activity, if you have unallowed passive credits related to property used in that activity.
An election. Okay, tell us about this election to increase the basis of credit property. That sounds like it could be very impactful. Say Alex had a rehabilitation credit from fixing up his rental property, but couldn't use it because he didn't have passive income.
It is very impactful, especially in that scenario.
Yeah.
If you dispose of your entire interest in a passive activity, or former passive activity, in a fully taxable transaction, sound familiar?
Entire interest, fully taxable, yes.
If you meet those conditions, you can elect to increase your basis in the specific credit property that was used in that activity.
Increase the basis of the property itself. By how much?
The increase is by the amount of the unallowed passive activity credit that originally reduced your basis in that property when the credit was generated. Many credits require you to reduce the basis of the property when you claim them initially.
So if a $10,000 credit reduced my basis initially, but I never got to use that $10,000 credit because of PAL limitations, I can add that $10,000 back to my basis right before I sell.
Exactly. This election allows you to restore that basis reduction caused by the unallowed portion of the credit.
How does that translate into real-world savings? What's the impact?
The impact is significant. This basis increase occurs immediately before the disposition. A higher basis means a lower taxable gain on the sale of that property, or potentially a higher deductible loss. It effectively lets you recover the tax benefit of that trapped credit, not as a direct offset in tax, but as a reduction in the taxable gain from selling the asset.
So it converts an unusable credit into a direct reduction of capital gains tax, essentially. That's a real dollar-for-dollar benefit on the sale calculation.
It can be, yes. It's a powerful way to monetize those otherwise granted credits. However, it's important to note, the amount of the unallowed credit that could have eventually been applied against tax in the future is reduced by the amount you use for this basis adjustment. You're basically choosing to get the benefit now via basis adjustment rather than waiting to potentially use it as a credit later.
Makes sense. Are there conditions for this selection similar to the loss release rules? Does it have to be the entire interest and fully taxable?
Yes, the same conditions apply. This basis adjustment election is only available if you dispose of your entire interest in the activity and the disposition is fully taxable. You cannot make this election on just a partial disposition of your interest or if the disposition isn't fully taxable, like gift or a 1031 exchange.
Okay.
But any unallowed credit that you don't elect to add back to basis or can't still remains available as a suspended credit. It can carry forward to potentially offset tax attributable to net passive income from other activities in the future. So the credit isn't necessarily entirely lost if you don't make the election, but the basis adjustment is a specific, powerful option available only at the point of a qualifying disposition.
Good to know it's an election, not automatic. Are there any special allowances for credits similar to that $25,000 allowance for rental real estate losses under active participation?
Yes, there is a parallel allowance for certain credits from rental real estate activities where you actively participate.
Active participation again, not real estate professional.
Correct. If you actively participated, you might be able to claim certain credits like low-income housing credits or rehabilitation credits from older buildings up to the deduction equivalent of $25,000. This means the credits can offset the tax on up to $25,000 of non-passive income.
So it mirrors the loss allowance, same income phase out.
Yes, exactly. Like the loss allowance, the special credit allowance is reduced by any passive losses allowed under the $25,000 exception on Form 8582. And it also phases out completely if your modified adjusted gross income is over $150,000 or $75,000 for married filing separately, with a phase out starting at $100,000 or $50,000.
Hmm.
So for Alex, if he actively participated in his rental, this allowance could have been useful for utilizing some credits along the way, assuming his income wasn't too high.
What about credits from publicly traded partnerships, PTPs? We know their losses are handled separately. Are credits handled separately too?
They are, and it's quite specific and restrictive. Special rules apply to credits from PTPs. Generally, passive activity credits from a PTP can only be applied against the tax that's tributable to passive income from the very same PTP.
Only against income from that specific PTP. Wow.
Yes, and crucially, that $25,000 special allowance we just discussed for actively participating in rental real estate does not apply to any passive credits coming from PTPs.
No $25,000 allowance for PTP credits.
Correct. You have to handle the income, losses, and credits from each PTP essentially in its own separate silo. You don't even report PTP activities on Form 8582 or 8582CR. The allowed and unallowed credits from each PTP are figured separately, usually based on information from the K-1 form, and you have to keep your own records of the unallowed credits to carry forward specifically for that PTP. Each PTP is its own self-contained passive activity world for tax purposes.
That really underscores the need to keep meticulous records and know exactly which forms to use for which situation. Let's talk about navigating those forms and some future strategies, because knowing the rules is one thing, but applying them correctly on the tax return is definitely another. What are the absolute key forms listeners need to be aware of in this whole process?
Okay, the primary forms specifically for the passive activity limitations themselves are Form 8582, passive activity loss limitations for figuring the limits on losses, and Form 8582CR, passive activity credit limitations for figuring the limits on credits. Those are the core PL forms.
8582 for losses, 8582 CR for credits.
Got it. What about the other limitation forms we discussed?
Right. You'll also very frequently encounter Form 6198 at-risk limitations, which, as we established, needs to be dealt with before you even get to the passive loss rules on Form 8582.
Basis, then at risk, Form 6198, then PAL, Form 8582. Exactly. And then potentially, after the passive loss rules, non-corporate taxpayers might need Form 461, Limitation on Business Losses, for that final excess business loss check. Those four, 8582, 8582CR, 62198, and 461, are really the central nervous system for calculating and managing these specific types of losses and credits.
So those are the core four calculation forms. What about the other more general tax schedules where the original income and losses from the activities are first reported?
Right. You'll also, of course, be using the underlying schedules and forms where the income or loss from your specific activities originates. This includes things like Schedule C for sole proprietorships, Schedule E for rental income and income loss from partnerships and S-Corp, Schedule F for farming activities, Form 4797 for reporting sales of business property like a rental building, and Form 8949 along with Schedule D for sales of capital assets like stock in a passive S-Corp. The allowed amounts, after navigating all the limitation forms, ultimately land back on these originating forms.
Once you figured out your allowed losses on Form 8582, how do you actually report them back on these other forms, like...
Right. In that case, you'll typically enter EDPA to the left of the entry space on the forms where you report the sale, like Form 4797 or Form 8949 Schedule D. This tells the IRS that this loss is fully allowed due to the special entire disposition rules, not the regular PAL limits. Following these notations is important for clarity.
And what if the activity has different types of losses being released, like maybe some ordinary loss and some capital loss, or capital losses subject to different rates? Does Form 8582 handle that complexity?
Good point. Yes. Form 8582 and its worksheets are designed to allocate the allowed loss proportionally among all your passive activities that have losses, and also among different types of losses, like ordinary versus capital, within an activity if necessary. There are specific rules, for example, for tracking and reporting 28% rate capital losses, like from collectibles, separately on forms like 8949. The key is to correctly identify the amount and character of the allowed loss flowing from Form 8582 and make sure it's reported on the correct line of the correct schedule with the proper identifier, POL or EDPA. This attention to detail is paramount.
This all sounds like a tremendous amount of numbers and characterizations to track, potentially over many, many years. I imagine record keeping is absolutely paramount here, maybe more so than for almost any other area of tax law.
It cannot be overstated. It is absolutely critical. You must keep detailed, meticulous records of your unallowed passive losses and credits, broken down by activity, to carry them forward correctly to future tax years. The IRS instructions for Form 8582 explicitly state this responsibility lies with the taxpayer.
What happens if you don't have the records?
Without proper records, including documentation showing the original sources of the losses, how they were calculated and suspended in prior years, and how they accumulate year after year, you simply won't be able to substantiate those losses when you finally have the opportunity to utilize them, like upon disposition.
So you could lose the deduction entirely.
You absolutely could. It could mean missing out on significant tax savings years down the road, or facing a painful disallowance during an IRS audit if you can't prove the carry-forward amount. This isn't just a nice-to-have recommendation. It's a fundamental must-have requirement for benefiting from these rules. Keep those prior year tax returns and worksheets.
I can only imagine the nightmare of trying to reconstruct that years later during an audit. Okay, what about grouping of activities? You mentioned this earlier in the context of the real estate professional test and entire dispositions. This sounds like a strategic choice taxpayers can make, but also one with potential pitfalls if done wrong.
It is a significant strategic choice, and one that requires careful consideration and consistency. The rules allow you, under certain circumstances, to elect to treat one or more trade or business activities or multiple rental activities as a single activity if they constitute an appropriate economic unit.
Grouping them into one bigger activity, why would someone do that?
It can be highly beneficial for several reasons. For instance, for meeting the material participation tests. If your hours are spread across several similar activities, grouping them might allow you to combine those hours to exceed thresholds, like the 500-hour test for the group, making all the component activities non-passive.
Like Alex grouping his 3 side businesses to hit 500 hours combined.
Exactly. It can also simplify the process of netting passive income and losses if you have multiple passive activities that qualify for grouping. And as we discussed, it impacts the entire interest requirement for disposition. If you group activities, you generally have to dispose of the entire group to trigger the suspended losses for that group.
What factors does the IRS consider when determining if activities form an appropriate economic unit for grouping? It sounds somewhat subjective. How do you know if your grouping is valid?
It is based on facts and circumstances, but the IRS provides several objective factors to consider, and you weigh all relevant factors. The ones given the greatest weight are similarities and differences in the types of trades or businesses, the extent of common control and common ownership, the geographical location of the different operations, and any interdependencies between or among the activities.
Interdependencies? Like what?
That could include things like buying or selling goods or services between the activities, providing common services or management, having the same customers or employees, or even using a single set of integrated books and records.
So Alex is 2 coffee shops in the same city, sharing staff, management, and accounting, that probably could be grouped.
Very likely, yes. That sounds like a strong case for an appropriate economic unit. However, grouping his coffee shop with a completely separate, unrelated tech startup he invested in, probably not appropriate. They lack similarity, common operations, and likely interdependence.
So you can't just group things willy-nilly just because you own them. It has to make economic sense. And once you choose a grouping, are you stuck with it forever, or can you change it later?
Not necessarily forever, but you need to be consistent.
Yeah.
Once you choose a grouping, you must generally stick with that same grouping in all later tax years, unless the original grouping is determined to have been clearly inappropriate from the start, or there's a material change in the facts and circumstances that makes the original grouping clearly no longer appropriate.
A material change, like selling off part of the group?
That could be one example, yes. Or maybe the operations diverge significantly. But importantly, there are specific and quite strict disclosure requirements if you do change your groupings.
Disclosure requirements, what does that involve beyond just, doing it differently on the tax form? Sounds like paperwork.
It is paperwork. For tax years beginning after January 24, 2010, regulations require you to formally report certain changes to your groupings to the IRS. If you fail to properly report these changes when required, The IRS can disregard your intended grouping and treat each underlying trade or business or rental activity as a separate activity.
And that could be bad, right? Making it harder to meet material participation or release losses.
It could be very detrimental, yes. It could significantly impact your ability to utilize losses. You generally must file a written statement with your original income tax return for the first tax year you initially group activities, or when you add a new activity to an existing group, or when you regroup activities.
A written statement, what does it say?
It typically needs to provide identifying information for the activities being grouped, names, addresses, EINs if applicable, and include a declaration that the grouped activities constitute an appropriate economic unit based on the relevant factors. If you're regrouping activities, you also need to explain the material change in facts and circumstances that made the original grouping clearly inappropriate. It's all about transparency and documenting your reasoning to prevent taxpayers from just switching groupings year to year solely for tax advantage.
So you can't just change your mind on a whim to get a better tax result that year, and you absolutely have to tell the IRS formally if and why you're changing it. What about the net investment income tax, the NIIT? I've heard that sometimes triggers a sort of fresh start for a grouping, offering a unique opportunity.
That's right. There was a special rule related to the implementation of the NIIT. If you became subject to the NIIT, which is a 3.8% tax on certain net investment income above certain thresholds, regulations provided a one-time opportunity, a fresh start election, allowing you to regroup your activities in the first tax year you were subject to NIIT or chose to apply the rule.
A one-time chance to regroup. Why was that offered?
Because how activities are grouped can significantly impact the calculation of net investment income. This election allowed taxpayers a single chance to reconsider their groupings, specifically in light of this new tax. The new grouping chosen under this election would then apply for NIIT purposes and also for the regular passive activity loss rules for that tax year and all future years, unless another material change occurred. It was a valuable, but generally one-time chance to reevaluate your entire activity structure.
It sounds like the IRS does allow some flexibility on grouping as long as it's justified, disclosed, and consistent. But I imagine they can also step in and force you to regroup things if they don't like your grouping, even if you think you followed the rules.
Absolutely. The IRS retains the authority to regroup your activities if your chosen grouping fails to reflect an appropriate economic unit. And importantly, if one of the primary purposes of your grouping or your failure to group was to circumvent the passive activity limitations.
So if it looks like tax avoidance?
Essentially, yes. They're looking for groupings based on genuine economic reality, not just arrangements designed primarily to manipulate the PL rules, like artificially creating passive income to absorb losses or creating non-passive status inappropriately. It's an anti-abuse provision to ensure the groupings are reasonable.
So the big takeaway from all of this, from classification to disposition to grouping, is that understanding your activities and strategically planning for their eventual disposition isn't just about compliance, ticking boxes on forms. It's really about strategically maximizing your tax benefits over the long haul.
That's precisely it. It's about unlocking value that might otherwise stay trapped on your tax forms indefinitely.
It's truly about turning those suspended loss numbers into real dollars when the time is right.
Knowing when and how those suspended losses and credits are released can have a profound impact on your overall tax liability in the year of disposition, and potentially beyond if NOLs or capital loss carryforwards are created. It's really about being proactive in your planning, not just reactive when you file your tax return each year.
Okay, so wrapping up, today, we've taken a really deep dive into the, let's face it, complex world of suspended passive activity losses and credits. We've explored how disposing of an activity can be a powerful and often overlooked moment for your tax situation. We've seen how meticulously classifying your activities matters: material participation, active participation, real estate professional status, those rental exceptions. And how understanding those critical differences, plus knowing the specific rules for dispositions, the entire interest, fully taxable, unrelated person rules, and the nuances for gifts, death, and installment sales directly impacts your ability to finally unlock those valuable tax benefits.
This knowledge truly empowers you, the listener, to look at your investments and your businesses through a new, more strategic lens. It's not just about the income you earn each year, but how you proactively manage those deductions and credits over the entire life cycle of the activity.
Right.
The complexities of tax law, especially areas like passive activities, can definitely seem daunting. But hopefully, armed with this deeper understanding from our dives today, you feel much better prepared to approach them, whether you're looking at a current situation or planning for the future.
So the final question, the provocative thought for you listening: what does this all mean for you and your specific financial situation? Consider this. Are there past activities sitting there with suspended losses, or perhaps potential future dispositions on your horizon, where applying this deeper understanding could mean the difference between a wasted opportunity, those losses just expiring unused, and a really significant tax saving?
Maybe it's time to review your own activity classifications. Are they correct? Should you consider grouping or ungrouping following the rules? Should you re-examine those dusty carry-forward numbers from prior year Form 8582s?
Or perhaps plan your next business exit or property sale with these utilization rules firmly in mind from the start. The power to transform those suspended numbers on a tax form into real-world dollars in your pocket might just be waiting there for you to claim it.